Hi, greetings from the mountain path, the world of finance. Today we'll discuss and how the three financial statements like income statement, balance sheet, and the cash flow statements are linked. So understanding of these financial statement and their linkages is highly important for students who want to analyze financial statements as well as to learn valuation. So as a step towards valuation and the linkage of this understanding of this financial statement is extremely important. Let's start with some assumptions before. We'll assume that cost of goods sold at 45% of the revenue and sales and general administrative expense at 15% of the revenue, tax is 25%, dividend of and 10% of the net income, and the long-term interest for the long-term loan is 8%, and the interest for the short-term loan is 10% per annum. So we'll start with an assumption of sales revenue of 30 lakhs multiplied by 45%. So less COGS will give you a gross profit. And similarly, less SGA at 15% of the revenue, you'll get the EBITDA. And then comes the depreciation. The depreciation actually, it is linked to the difference between the accumulated depreciation that is appearing in the balance sheet or last year balance sheet as well as this way. The difference. The difference here is 60,000. So that is deducted in the from the EBITDA. So we got operating profit EBIT at 11 lakh 40,000. Now we have the next less interest cost or the financing cost. So that nothing but the short-term interest into the short-term loan and long-term interest into the long-term loan that will give you the interest cost. Now you have the earnings before tax, then at 25% tax, you deduct the tax, you get the net income. This net income is directly linked to the first item on the cash flow from operations. So that means the net income is linked. Similarly, the second item, the depreciation, and is also added. Either it can be linked from your income statement or it can be and the difference between the accumulated depreciation from the balance sheet. Now, so once you have this, now you have the 10% dividend from the net income, and that will go into deduction into cash flow from financing. Then we have the return earnings that will be added and to your reserves and your reserve last year reserves plus and this year reserves that will be added here. Now let's quickly go into and the cash flow from operation. So as we already discussed, cash net income is the first item that comes from the income statement. Depreciation is added that comes from the income statement again. So adjustment into and for working capital changes. So the increase in the accounts receivable that is there from the balance sheet of last year to this year, and similarly increase in the and inventory that is deducted. So increase in the current liability, that is one item, accounts payable, that is added. The cash in the and the balance sheet is not taken into consideration because that will be adjusted in the cash flow for all the cash balances at the end. We will discuss it. Now there is one. So that if you add everything, the net cash flow from operation, you have net income plus depreciation plus adjustment on working capital. Now, the third and second important cash flow from investing activity. So there is one item, there is an increase in the gross PPE, and this year it is 18 lakhs, last year is 12 lakhs. So that means the capital expenditure here, the long-term capital expenditure is deducted here, cash flow from investing. Now then comes the cash flow from financing activity, and we have four items here, and the equity capital that is added and that means what is the current equity capital, this year equity capital minus last year equity capital, that is a capital flow. Similarly, the short term capital, that means this year short term capital minus the long term, that means the additional short term loan. Similarly, the long term loan and this year long term minus the balance. So that means this thing. Now you have the three plus items. Now you have the what is your dividend that is paid, that is taken from your income statement, that is subtracted here. Now we can see that the sum of all the and cash from financing activity is there. If you add everything together, cash flow from financing activity, cash flow from investing activity, cash flow from operation, you'll get a balance. So your beginning balance from your balance sheet and add the balance of all the cash flow statement plus cash flow from the beginning. So that will go into your cash into your balance sheet. So that is directly linked from here. Now, so next is all these things are can be managed. If there is any item that you cannot balance it, you can always take one of the plug variable as a short-term loans to balance it, and you can do some adjustment here. So one important item is the reserves and these last year reserves plus this year reserves is added here. So the balance sheet is perfectly tallying. So understanding the linkage of important items from the income statement to the balance sheet and the cash flow statement is a and important. The more and more you look into different types of balance sheet, namely, how does a balance sheet and income statement of a manufacturing company you look, and how does a income statement, balance sheet, and a cash flow operation, how these statements will look from a financial institution point of view. How does a financial statement for a what is called non-banking financial institution will look into? So how does the financial statement of a financial services company or a company will look into it? The more and more you look into it and the balance sheet, income statement, the cash flow statements, you will have a clear idea. So what are all the linkages? And because this will be a first step towards starting the valuation. So next video, we will discuss how to value your firm using free cash flow to firm valuation. Thank you for watching. Thank you.